The crash of 1929 is often remembered as a thunderclap, a single day when the stock market fell from the sky and the Great Depression began. But history is rarely that simple. What happened in October 1929 wasn't just a bad day on Wall Street. It wasn't simply greedy speculators being punished. It was the end of a long decade built on optimism without limits, a financial bubble inflated by debt, leverage, and an almost religious belief in endless growth. And when that bubble burst, the world learned something uncomfortable. Confidence is a fragile currency. Once it disappears, no central bank and no politician can bring it back overnight. Let's strip away the drama and the myths. The crash wasn't a single moment of chaos. It was a process. Years of excess building quietly toward a breaking point that, in hindsight, was predictable. And if this sounds like an old story about ticker tape and men in top hats, think again. The same ingredients exist in our financial system today. Cheap money, speculative manias, inflated asset prices, a culture that insists markets always go up. The real lesson of 1929 isn't just how fast you can lose everything. It's how easily we convince ourselves the party will never end. The stage was set during the Roaring Twenties. America had emerged from the First World War as the richest nation on Earth. Industry was booming. Cars, radios, refrigerators, technology was transforming everyday life. Cities expanded, wages rose, millions bought into a vision of permanent prosperity. But beneath the glamour, the cracks were already there. Farmers were drowning in debt as crop prices collapsed. Wealth was increasingly concentrated in the hands of a few industrialists. Most households had very little cushion if things went wrong. Banks were loosely regulated and often reckless, lending freely to anyone eager to participate. And the stock market became the great playground of the decade. Between 1921 and 1929, the Dow Jones Industrial Average climbed from 63 points to 381, a six-fold increase in 8 years. Ordinary people joined in. Not just Wall Street insiders, but teachers, shop owners, factory workers. For the first time, millions of middle-class Americans became investors. Brokerage offices spread across the country. Newspapers and radio programs fueled the excitement, promising wealth to those bold enough to borrow and buy. And borrow they did. Margin trading became the defining feature of the bubble. Investors could put down just 10% and borrow the rest. With $1,000, you could control $10,000 worth of stock. As long as prices kept rising, leverage magnified the gains. But leverage works both ways. The moment prices dipped, brokers issued margin calls. Investors had to add cash or sell immediately. The higher the market climbed, the more fragile it became. One slip, and forced selling would cascade through the system. Even respected leaders fed the illusion. Charles E. Mitchell of National City Bank reassured the public. President Herbert Hoover promised prosperity in every home. The economist Irving Fisher famously declared that stock prices had reached a permanently high plateau. These were not fools. They were intelligent, experienced men. But intelligence offers no protection against collective euphoria. When optimism is rewarded and caution is mocked, even experts become cheerleaders for a bubble. By 1928, the Federal Reserve tried to cool speculation by raising interest rates, but credit had already flooded the system. In September 1929, the market peaked. Quietly, some large investors began selling. Rumors spread. Then, in late October, the dam broke. On October 24, Black Thursday panic selling began. A record 12.9 million shares were traded. Banks tried to restore calm by buying stocks. It worked briefly. But on October 29, Black Tuesday, the panic returned with full force. Over 16 million shares changed hands. The ticker tape fell hours behind. In a single afternoon, fortunes vanished. But here's something important. The crash did not cause the Great Depression by itself. It was the spark, not the fire. The real damage came from the fragility of the system and the policy mistakes that followed. Banks had lent recklessly. When loans defaulted, they collapsed. Between 1930 and 1933, more than 9,000 U.S. banks failed. Millions lost their savings. With credit frozen, businesses couldn't operate. Production collapsed. Unemployment reached 25%. Global trade shrank as countries raised tariffs and turned inward. A financial crisis became a worldwide depression. And yet, none of it was inevitable. It was the result of choices, weak regulation, unchecked speculation, blind faith in growth, and hesitation when decisive action was needed. Between 1929 and 1932, the stock market lost nearly 90% of its value. The Dow fell from 381 to 41. Imagine watching your savings evaporate day after day. There was no federal deposit insurance, no safety net. If your bank failed, your money was gone. Governments tried to respond, but some policies made things worse. The Smoot-Hawley tariff triggered trade retaliation and caused global trade to collapse. Leaders clung to the gold standard, tightening policy when they should have been supporting demand. Countries that left gold earlier recovered sooner. By the mid-1930s, the world had changed. In Germany, economic despair fueled extremism. In America, Franklin Roosevelt launched the New Deal. Financial reforms followed. Deposit insurance was created. Markets were regulated. These were attempts to rebuild trust. Because without trust, capitalism breaks itself. Now, ask yourself, why this still matters. The mechanics of 1929 are not dead. They reflect human nature. We saw echoes in the dot-com bubble, in the 2008 financial crisis. The details change: railroads, tech stocks, housing, crypto, but the pattern remains the same. Easy credit, speculation, collapse, and then the search for blame. And every time, the same phrases return. This time is different. We've reached a new plateau. The fundamentals are strong. The crash of 1929 reminds us that the most dangerous moments are not when panic begins, but when complacency feels comfortable. Look around today. Years of ultra-low interest rates have inflated asset prices. Trillions in debt sit on balance sheets. New speculative arenas attract millions of ordinary investors who believe the system will protect them. History suggests otherwise. When confidence cracks, protection disappears. And those at the bottom of the pyramid suffer first. The true lesson of 1929 is resilience. Those who diversified, who understood cycles, who avoided excessive leverage, they survived. Some even emerged stronger. Those who chased easy profits and borrowed aggressively were destroyed. That dynamic never changes. So ask yourself honestly, if markets fell sharply tomorrow, if credit froze, if your bank account was suddenly inaccessible, how prepared would you be? Would you be the margin trader of 1929? Or the investor who understands that real wealth isn't paper promises but durable value? History doesn't repeat, but it rhymes. The instruments change, the psychology does not. Greed, fear, denial, collapse. The crash of 1929 isn't just a historical episode. It's a mirror. It forces us to ask whether we've learned anything or whether we've simply become more sophisticated in our illusions. The conclusion is simple. Don't worship markets. Don't confuse speculation with wealth. Protect yourself with knowledge and discipline, because the system is not designed to save you when things go wrong. And at some point, they always do. If this gave you a new perspective, hit subscribe